Well, it's an interesting discussion we're going to have this morning with Tobie van Heerden and Gareth Stobie, who up until yesterday were competitors. Tobie, you're from 10X. Let's introduce you. 10X, there you can see the picture on the screen. Your logo is there, not Gareth's logo, because I suppose it gives us a little bit of a hint of what's going on here.
Yeah, I wouldn't say we're competitors. We're operating obviously in the index space, but Coreshares and Gareth were operating in the intermediary space, purely selling to intermediaries, and we were in the direct-to-consumer space. So we haven't even sort of crossed paths yet. Although, if you fast track this maybe 6 months, we would have crossed swords if we didn't do the transaction. Yeah.
You've built this business for a decade, Gareth.
I have. I mean, if you look back on my career, I worked for a long time at Vanguard Bank, and we started launching ETFs back in 2012, and then we launched Coreshares a couple of years later, 2015. And we've been on this journey to build a contemporary passive asset manager, challenger brand to some of the big market incumbents. And I think to Tobie's point, I think 10X and Coreshares have followed a similar but different journey. So 10X has been very retirement focused with as Tobie says, big D2C book, whereas we've been focused on the ETF market. We've also got a range of collective investment schemes, but positioned slightly differently. And more recently, building segregated accounts for clients. So we have often stood up at conferences together, both promoted the passive market. But when Tobie and his executive team approached Coreshares about a transaction, there really was a great fitting in terms of our complementary product sets and also our complementary client channels. So that's why it felt good for Coreshares to take this new step in our journey, because we boost our assets from 12 billion under management. Now under 10X, that suddenly shoots over 30 billion. And in a passive industry where scale is everything, suddenly a lot of things start to click. And I think we're very excited.
Let's just dwell a little bit on the scale story. Over 30 billion, according to the official statements that are coming out. Is that to be big enough now to be a real player in the South African asset management space?
It's not there yet, Alex. We're on our way. If you look at sort of South African industry, you typically get managers, especially in the passive space, stuck at like 10 billion. And then to make the move from 10 to 30 is quite tough. It's a hard road. Yeah, we're doing it inorganically to 30 billion, but to move from 30 to 50 is pretty quick.
And then the big guys, Alan Gray, Coronation, the 91, I was thinking the old Investec. You know that business quite well, don't you?
Pretty well. I was there for 16 years, so yeah, we're still good mates.
How big are those guys? What is their scale?
91 is gigantic. They are in South Africa. I think 91 is 700 billion.
All right, so there's quite a big jump then to the next.
But in passive, if you look at the global market, and I mean, I don't want to get too fixated on the South African market. I think when we look at passive and index investment, we should look at our global peers, because that's what we're aiming for here. The big five really takes the whole market globally. So it's BlackRock, it's State Street, Vanguard. They take the market. And in South Africa, we haven't got that yet.
Let's just step back a little, because I kind of jumped into it, introducing the two of you. The news angle here is that 10X has acquired Coreshares. Coreshares was started by Vanguard Bank and the RMI and Outsurance. They were your shareholders in the past, Gareth. Yeah. Were they willing sellers?
The conversation that we've had at a board level, and maybe I should also take a step back, they've been incredibly supportive shareholders for us, both in terms of providing growth capital. Coreshares, we run a proper business. We've got a highly talented team, best-in-class infrastructure around how we've been managing money, and that takes some capital investment, and we've also built a brand over the years. So they've been very supportive from a growth capital perspective, guiding me and the management team. Where we've had an honest conversation at a board level is that scale is critical in the passive market, and it was important for Coreshares to work out how through time we were going to unlock scale, and if that meant distribution partnerships, JV partnerships, or indeed changes to shareholding, then as a board we should be open-minded about that.
So you didn't go fishing?
No, not per se. We had cups of coffee around that particular strategic problem in the business, if you want to call it that. And through those cups of coffee, we interacted with 10X to say, well, would it make sense to put these two businesses together? And then ultimately, the 10X shareholders have got a very expansive view on the passive market, and they were keen to take the funding forward and ultimately bought out our shareholders. So we now fall under the 10X umbrella.
The thing that's real interesting to me is that you're both entrepreneurial. You clearly are. You've started entrepreneur, I suppose you could call it, because you've worked within an organization and you've built this business there, leading it from the front. Tobie, I know you have an entrepreneurial flair as well. You understand fintech. You understand a lot of exponentiality, etc. So I guess if you stand back, you say, well, if these two guys can work together, and I suppose that question will be told only in time, then you could have quite a potent team going forward into the expansion basis. Are you letting your mind dream or looking into those areas yet, Tobie?
Alex, I don't think we're even dreaming. It's a strategic focus of ours. We're very clear, and when I took over September last year, the first thing I did for a couple of months, and actually before that, my mind was already going, is where can this go? So we did some.
Where can 10X go?
Where can 10X go? And that is organic growth, inorganic growth, looking at various things in terms of its current distribution channels it was servicing, what distribution channels it should be servicing, what product as it got, where should the product range evolve to, what assets can you gain in those. So we did a hell of a lot of work around that, and I presented to the board, and so we have a 5-year view here of what we're going to try and execute, and I can tell you it's large numbers that we're aiming for. So it's we're thinking big.
Is this step one then, in other words?
So this is step one in a broader strategic rollout. So I think in the next couple of months we'll be talking to you a bit more about other things that we're planning, we're doing, and it's aggressive. And that doesn't say we're going to acquire the world. It's not about acquisition. It's about doing interesting transactions. It's about the products that we're rolling out to our clients, getting this global mindset into our business and rolling that out. Where, as you say, scale is absolutely key in the passive space.
Why? Just unpack that.
So our fees are low. So unlike our active peers, they
active means people who then they go and buy and sell shares.
Yes, so they
after they've researched them. You guys passive means you follow indexes.
Yeah, so in an active business, the fee rate is effectively 3, 4, 5 times higher than ours. So
still, even with competition.
Yes, so they make a lot of money on that, but then they also got a slightly higher cost structure because they got to pay for expensive portfolio managers. Whereas in the passive side, we've got to get the scale to get the revenue in. Once we have the revenue in, the scale helps us to bring efficiencies in our business where we can get our administration costs down, operational costs, and this is where tech comes in for a passive business. If you can automate and you can bring in very clever tech in your business, you can actually reduce your costs even more. So it's like client acquisition. How cheaply can you acquire a customer in terms of them accessing your investment through an application form, that whole process? If you can do that for a fraction of the cost, your cost comes down. And then you can make more money, but you need scale to do that.
Like the Chinese have shown us in manufacturing. But you've been in the passive area, in other words, exchange-traded funds. In the last 10 years, from when you launched your first ETF at Grindrod Bank, how has the market reception or the retail investors' perception of passive funds, and you've mentioned that a few times, how's that changed?
It's definitely grown since we started Coreshares, and I think the ground has become more and more fertile as well. I think we actually have to thank the media for a large part of that, actually, Alec, because they've been tremendous help in terms of educating the market and helping passive firms get the news out there around the different approaches to savings products. I mean, I think if we look back at the early Coreshares business plan, which was largely premised on a top-down analysis to say, how's the South African savings market constructed? What percentage of it is in these passive funds, whether they're ETFs or other types of CIS funds? And where do we expect that trend to go longer term? And if I look back now, there's definitely been a step change in terms of the asset gathering. I think there's still a lot more growth still to come in terms of how these types of savings products are used in the market. But when we got going with, say, 3-4%, now it's at 8%, which doesn't sound like a big shift. But bearing in mind that we've got a very mature savings market in South Africa, over 3 trillion rand in collect investment schemes. So a shift from 3 to 4 to 8, what we think will be 20% in the not too distant future, means that there's a large pool of assets to manage.
Tobie, is that 20%? Is that a realistic figure for South Africa? What's it internationally?
So let's contextualize that. In Europe, you're sitting at around 26 to 28% in index. In Asia, you're sitting at 24%, 25%. The outlier is here in the US, where you're sitting at close to 50%. But that's because they got a system called tax harvesting in their ETF. So it's very tax efficient for investors to go through an ETF. So let's say the run rate globally is sitting at around 25%. There's no reason why we should be sitting in the mutual fund space at 15%.
Mm-hmm.
Then so that's mutual fund. If you then look at the institutional market, I reckon we're probably sitting at 2%. And if you think of our institutional market, who's that? That's people that's going to be pensioners that's currently saving through a formalized system where fees are absolutely critical. So if we can get that institutional rate up from a 2% to a 15 or a 20%, and actually, if I look at the global peers in the institutional space, it's sitting north of 50%. Because there you have sophisticated investors that can do beta replication or index investing, and they can pick the alpha over that. So consultants can do the work. There's a question of our market needs to get there, and our market hasn't got there really, because I don't think there's been really a pure play independent player out there in the index space that can actually go with this and can build solutions for their clients.
And that's why you called it Coreshares, because it's a core of your portfolio. So it speaks to the same thing Tobie's been talking about now.
Completely. I think, when we've at a integration level, philosophically, we see the market very much along the same lines. It's not this binary active versus passive debate. It's really around when either a financial advisor or perhaps a consultant or a pension fund puts a portfolio together, how can they do that in a way that best serves their clients? And having a low-cost core to that solution makes a lot of sense. We would further argue that being strategic or systematic around how you do that also makes a lot of sense, rather than trying to be tactile and call these markets as we currently have them. That's enormously difficult. But yes, that was our thinking. And we specifically stayed out of the whole active versus passive debate, because we see a lot of good active managers out there. But notwithstanding that, they're difficult to find, they're difficult to pick in advance. So to have this core part of your portfolio that's run low cost and you're just getting the market return makes a huge amount of sense.
And you said earlier that the media has helped. I think a much bigger help has been the performance when passives have just given active such a hiding. However, with the turbulent markets that we're seeing at the moment, and this is an interesting point, the active managers are saying, you see, come to us and we'll do better for you because we'll make the right calls.
That's not necessarily a fact-based analysis, Alec. That's what they're...
Well, it's good marketing at the moment.
Perhaps. But I mean, we did some analysis during the COVID crisis, and actually index funds, if you sort of draw back through this whole funny 2 years in our lives to the start at like March 2020, and you roll back that time analysis, you'll find that active managers didn't actually do a great job in terms of finding that defensive underpin to clients' portfolios.
Not as a whole, but and I think this is really what we're getting to. You got to look.
Correct.
Why should you have the market dominated by lots of active managers when actually you want to get the best of them? And maybe the not so good ones are also in there at the moment. Is that
correct?
Kind of the argument?
It sounded for a moment like I was bashing them again. I wasn't. I was just saying that passive has a role to play throughout cycles. There was a narrative that was painted at one stage by the active houses that passive is something that's worked over the last 10 years because of this free money in the system and so forth. Actually not. It's a structural change in the industry where people are using these tools long term to build solutions. There will always be pockets of excellence in the active management industry who are getting performance at certain times in the market. But that's cyclical, and as I say, they're difficult to find and so forth. So we think it's a structural change in the market where practitioners are using these tools more and more and more, building funds and solutions.
And maybe to add to Gareth's point here, and I mean, I've come from an active business for 20 years. So I can't sit here with you today and say, you know, active management is not there, it's not real. There's very good active managers out there. I worked for one and there was fantastic portfolio managers. But this structural shift we're seeing now is actually an opportunity for active managers. Because, you know, what passive managers are doing, and as this rise up, it's going to give active managers, and the good ones, more opportunity to create alpha.
In other words, create outperformance.
But it's going to be at a smaller scale. So I think that's where active managers must sort of take a step back. Are we all about growing our assets exponentially, but we're probably giving away our active sliver here, because the bigger we are, the less active management we can create? Or are we going to be quite niche and use this opportunity to create alpha for our clients?
Getting back to this deal, to 10x acquisition of Coreshares, you did mention right at the beginning that there are two different distribution channels. In other words, 10x has always been known to be direct to the consumer. The consumer gets the best deal because you look around the market, whereas Coreshares work more through intermediaries, through financial advisors. How's the new business going to look, given that you've now increased so much in scale?
Alex, I would say much the same, but just under one brand. So if you think about how we access and how we want customers or clients to access our portfolios actually very efficiently through technology, make it very easy for them to invest, and take away this whole nuance of it's elitist to invest. We want to remove that from the system. And you know the eighth wonder of the world?
Compound
interest. So we've seen it. So that's where you want to take that sort of what we call the D2C or the direct market. Very focused product set. And obviously, as you go up the complexity curve, there's some investors that say, you know what, I want to invest in the top 60 because I think it's an opportunity. And now with Coreshares, we can offer that to that customer base of ours. When it comes to the intermediary space, all of a sudden we can give the intermediaries a much broader system here to access. So they can now, for once, they can access 10x products, which they couldn't have done previously because it was only available in the D2C space. So we're giving that broader set to them.
D2C?
Direct to consumer.
Okay.
So you guys, a bit of tech talk. Sorry.
Yeah, it was not tech talk. It was like a bit of jargonish, but I get it.
So it's the man in the street that we basically going to, the average South African. It's about financial inclusion. You know, we're all about that at 10x. And with having the intermediaries on our side, you know, helping the intermediaries to build portfolios where passive becomes quite a large chunk of that, they can actually then bring costs down to their end customer, and everybody scores in the end. But it's about giving that financial intermediary access to the right quality passive product, and I think that's where we want to end with this.
I've been thinking quite a lot about the lessons we can learn from the market. Can't call it correction. It's a proper crash now that we've seen in the stock markets. And the biggest lesson that came through is a real old one, and one that I think both of you have been whipping the horse for a long time, and that's the benefit of rand cost averaging. In other words, don't go and take a bet at one point in time. With our BizNews portfolios, we try to offset it by saying invest over 3 months. But how much better to be investing a certain amount every month into the future? Have you done much analysis of the, I suppose not of the latest one, but of the benefits that you get from rand cost averaging? In other words, putting a set monthly amount aside rather than taking a punt and, unfortunately for some people, buying at the top of the market.
I mean, we've done some work on the adverse where people actually pulled money in March 2020 just as the market crashed because they were scared and they didn't reinvest it. The difference in your portfolio is around 40%.
Wow.
So instead of having 120, you have 80. So now you get the compounding on 80 instead of 120. So Gareth, you and Chris have done a lot of work on that recently, and we maybe can present it to you at some point. But it's astonishing to see the adverse effect of that. So it's not the eighth wonder of the world for nothing, but consistently putting money away over time, you'll do well. And that's the sort of, I'm not allowed to give advice really, but you know, my parents, you know, that's the golden rule. Yeah, that's what I say to them.
Yeah, it's that whole time in the market, not timing the market. And if you're investing long term throughout your career and chipping away at it, that's the irony of our industry. It's always very news heavy, but actually it should be very boring, because it's all about just that consistent chipping away at a long-term savings goal. And then when you get to retirement, you then reverse it and you start drawing down on that savings pot. So we try and look at that very strategically. And we share the same investment philosophy, by the way. We're coming together, the two firms. The investment teams are click on these issues. So it's about thinking.
They're key.
They absolutely are. So and that's about thinking strategically and systematically around how you build that pot of wealth over the course of your career, and then the converse, how do you draw down on that in a sensible way. And that's around getting asset allocation right, not being too tactile when you see these changes in markets, because it's very difficult to get that call right. Keeping costs low, and staying diversified. Indices are inherently well diversified. Both firms have actually also got an approach to ensuring that not only investing in indexes, but you're not going overweight the mega cap stocks, which some market cap indices do. There's a bit of common sort of ground there too around keeping that sensible. Those age-old sort of lessons around saving and
the interesting stat we actually did do is once you now accumulate consistently, it's a difference that fees makes on your portfolio. So how's this for one? So a 1% difference in fees. So instead of paying 2%, you're paying 1% over 20 years, irrespective of the investment return you'll have over 20 years, makes a 30% difference in your accumulated value at 20 years. A 1% difference in fee make a 30% difference in your accumulated. So if you had R1 million you invested, it would have been 1.3 million at the end with a 1% difference in fee. So
eighth wonder of the world. Yeah. Making money on money. Just to close off with, what about the future? What are you seeing 10x now, bigger, stronger? You've said this is the first of many more deals. Where would you see the scale being at a level where you'd say, okay, we're now able to provide the best possible service to our customers, to our clients, and also to our shareholders?
I mean, I think we're already at that point where we can provide a fantastic service. Would we like to do better? Yes, we would.
Well, you'd like to cut the costs to clients, surely,
exactly.
Lower fees.
So I think at current levels, we're okay, but we're not there yet. We would like to get to 50 billion quite quickly, which will give us some more scope. But I think once you go over the 100 billion mark, that's when you really start getting into the sweet spot. And at over 300 billion, that's where you really can take this market by storm. And that's actually where we want to be. I believe in the next couple of years, and couple of years could be 3 to 5 years, there needs to be one $300 billion index player in South Africa. If that doesn't happen, I can see the likes of a BlackRock or a Vanguard coming into this country, and they're just going to take it. So I'd rather that be a homegrown play than one of the big guys coming in to take this market. So we're fighting for survival, but we're also fighting for the growth here. And that's what we're setting this business up for, is to be that premier player in that space if it starts happening.
And Gareth, you've carved out a 10 billion rand assets under management business over the last decade. What would you see the future of Coreshares under the 10x banner? Well, I suppose let's start off. Is it still going to be called Coreshares? It's going to be called 10x?
We're ultimately going to be called 10x. I think 10x has done a great job in terms of building its brand in the retail market. Both brands are similar, colourful, contemporary, pro-consumer, and so forth. The reality is the 10x brand has got more goodwill and brand value behind it. So we'll be slowly migrating the Coreshares brand to become 10x.
And looking back in 5 years' time, presuming you're still there and somebody hasn't come and snapped you up and given you that offer you can't refuse, what would you what would you like to be looking back at?
Yeah, I think certainly from my side, seeing the Coreshares legacy thrive under a new, bigger, stronger firm, as you put it, would be a wonderful thing to see through. So we see ourselves part of this new journey, we've walked as I said earlier, we walked a very similar path to 10x actually in terms of trying to build up a passive business, and I think the DNA is actually very similar as well. So we feel as a team very comfortable, moving the business under this new structure. And success would look very much like Tobie's defined it, having this large sustainable business that is delivering good outcomes for clients. I feel like the conversation's been quite industry heavy, but the reality is we are a very client-centric a business at the end of the day. I think there's a good degree of purpose around what is it we're trying to achieve. The other thing scale is going to give us, I should have touched on this earlier, is the ability to lift our heads a bit and look at other trends in the market. So ESG, for instance, it's critical that asset managers free up space and capacity to implement ESG thoroughly in their portfolios. And having a bigger asset manager, you need to have scale there as well. So those are some new trends that we need to tackle as well.
It must also be easier with things like compliance. The bigger you are, the more you can leverage that.
Exactly, yeah. So the leverage in the business is just amazing. So the platform we currently have in terms of staff, we can scale this business easily to 100 billion. I mean, our investment team currently can run 150 billion. There's no problem without hiring too many new faces. So that's the amazing thing about the platform we actually got here to grow from. Compliance is one of those. Finance is the other. Where you'll add probably is around the sort of the sales distribution client, what we call client engagement.
So
side of things.
Who should be worried about this transaction?
Our competitors.
Which competitors?
You know them.
The big guys.
Yeah, the big
guys in your space.
And the guys who aren't evolving their businesses as well. So I mean, Tobie touched on the active guys who can shift their value proposition around giving proper value relative to the index. If there are firms out there who just providing the index, sometimes less than the index, and then charging high fees, those are the competitors where they're in our target, because
your crosshairs.
Yeah, our crosshairs. Thank you. In terms of under delivering in the market. In fact, some regions, like those firms have even been fined by the regulator for not delivering proper value to the consumer and charging high fees. That's how extreme it's got in some markets. So those are the firms that are likely to lose market share through time. The firms that are likely to retain market share in the active space are those that are truly active, providing high active share to clients and real value to clients. And then the passive market should grow structurally through that period.
Maybe to answer your question a bit more directly, now that I've thought about it, Alec, is I think there's two camps that should be worried about purely in the passive space. The one is where you're tied to a bigger mothership. Why is that the issue? Because I think you're going to struggle to get your costs down because you're paying a lot of cost up to your mothership. The second one is where you run a business where it's vertically integrated. In other words, you're selling multi-managers, you're doing everything. There's a lot of costs that are unseen there that you take from investors that's not necessarily disclosed. Where we run a pure play index business, what you see is what you pay. And those are the sort of the two camps that I think should sit up and watch, because we will be very transparent. We'll be very clear around this is what we provide. This is the benefit you can get, and we're super excited about that actually.